Hello, can one build a portfolio that has the potential to outperform returns from real estate? And get this, the vehicle where this portfolio is built has at its core capital preservation and regulatory oversight comes first. And get this, it's diversified. Additionally, it's professionally managed and has numerous checks and balances to ensure you, as the investor, your funds are protected. I'm talking of the collective investment scheme, the super duper chama. Yes, it's modeled like a chama, but if correctly structured, it has the potential for good returns, and you don't have to be a professional to run it. Anybody can do it. Hello, my name is Timothy with Pete and Pete Investors. At Pete and Pete Investors, we provide financial literacy to our members and provide the tools that they can use in their journey to personalized financial freedom. Today, we open the hood and see how the CIS is structured, how it's managed, and how it can be a powerful tool to build a real good portfolio. And because I am a data guy, at the end of this, I will provide you the data for you to decide whether this is something that's worth your attention. So, if this is information that interests you, karibu. Welcome back. We are going to talk about something many of you have already come across or may even have invested in, and that's collective investment schemes, or what some people usually just call it unit trusts or funds. Some of you may already own a money market fund with your bank or an investment firm. What I want to do today is pull back the curtain a little bit, and I'll show you exactly how these funds are regulated in Kenya, who is responsible for keeping your money safe, and how the rules around where that money can be invested actually works in your favor. By the end of this session, you'll feel confident enough to ask the right questions before you invest a single shilling. Let's start with the basic. Think about how a chama or an investment club works. A group of people each contribute money, and someone, usually the most trusted, is given the job of investing it on behalf of everyone. A collective investment scheme works on the exact same idea, just done on a much larger scale. It's more formal and more regulated. Instead of 10 or 20 members, you have thousands and thousands of investors. Instead of a trusted friend managing the money, you have a professional licensed fund manager whose full-time job is to invest wisely. And instead of the cash sitting in someone's personal account, I know you, it's held completely separately by an independent institution purely for your protection. So, in short, many people's money pulled together, professionally managed, and kept safe apart from the people who are managing it. Who makes sure all this is done properly? That's the job of the Capital Markets Authority, CMA. Think of CMA as the referee of Kenya's investment world. Before any fund can even open its doors to the public, it has to be approved and registered by CMA. So, before you invest any money, just go to the CMA website and look to see whether the fund manager or the institution is licensed by the CMA. And once it's running, the CMA doesn't simply walk away. It keeps monitoring how the fund is priced, what it discloses, and how the people running it behave. If something goes wrong, CMA has real power to step in, restrict what a fund manager can do with the money, and force corrective action. Investors' protection is literally why the authority exists. Here is something that may surprise a lot of people. No single company or person is allowed to run a fund on their own. The CMA insists on 5 separate independent parties being involved, each with a different job. almost like a system of checks and balances. First, the trustee. Think of them as the guardian of the fund. They hold the legal title to the assets on behalf of the investors. Second, the custodian, and it's usually a bank whose only job is to physically keep the cash and securities safe. Third, the fund or asset manager. This is the person who actually decides what to buy and what to sell. Fourth, the investment advisor, who provides research and guidance behind those decisions. And fifth and finally, the auditor, an independent professional who checks the books every year and reports what he finds both to the investor and to the CME. 5 different players, 5 different responsibilities, and none of them can act alone. Why does this separation matter so much? Because it means no single person can simply run away with your money. The fund manager who decides what to buy never actually holds the cash. They can't help themselves to it. The custodian who holds the cash has no say in what gets bought or sold, so they can't be tempted to make a bad call with it. The trustee is watching over both of them, and on top of all that, an independent advisor who comes once a year to verify that everything adds up. It's a system built so that trust doesn't rest on any one person's good character. It rests on a structure. So unlike the chama, no single person, there's a structure in place which makes sure that trust is held and everybody's money is safe. Not every fund is the same. And that's usually good news because it means there's likely one that matches your own comfort and risk levels. A money market fund is the most conservative. It's about protecting your capital and keeping your money accessible. It's a bit like a high interest savings account. A fixed income fund invests mainly in government and corporate bonds, aiming for steady income. A balanced fund mixes shares, bonds, and money market instruments together, spreading the risk. An equity fund invests mainly in shares listed on the Nairobi Stock Exchange. It can grow more over time, but its value will also rise and fall. So it's more risky. And then there is a special or sector funds which focus on a specific theme or strategy and carry more risk in exchange for potential higher returns. So always remember, the higher returns, the higher the returns, the higher the risk. The right one for you depends entirely on your goals and how comfortable you are with the ups and downs along the way. How does CMA make sure each fund actually behaves the way its name suggests? Since 2021, the CMA has set out a specific rule for each type of fund. A money market can only invest in interest-earning assets, things like fixed deposits, government securities, and highly rated commercial papers. And those instruments can't run longer than 13 months. Money market funds, they can only invest in short-term securities. So it's usually just government treasury bills, the 90 days, the 160 days, and the 365 days. That keeps the money liquid and low risk. On the other hand, an equity fund must keep at least 60% of its money in shares. So it can't quietly turn into something else. A fixed income fund must keep at least 60% in bonds. So usually it will invest in longer term government bonds and corporate bonds. A balanced fund is capped so that no more than 60% sits across money markets, bonds, and shares combined, forcing genuine diversity. And then there is a special funds. They follow whatever strategy the manager has clearly stated upfront. Though, as we will see next, even they aren't left completely free. The bottom line: a fund actually has to invest the way its name promises. It isn't just a marketing label. Beyond those fund-specific rules, there's a second layer of protection that applies to every single fund, no matter its type. It's called Regulation 78. It sets the maximum limits on how much of a fund's money can sit in any one category of investment. For example, no more than 80% can sit in share listed on the Nairobi Security Exchange, and no more than 80% in government securities. Investments in things like unlisted companies or properties are capped much lower at 25%. And anything invested outside of Kenya is capped at just 10%. Think of this as speed limits, not speed targets. They exist purely to stop a fund manager from putting too many eggs in one basket, no matter how good that basket might look at that time. Now let's put all this together, and you see why collective investment schemes are generally considered a relatively safe way to invest. First, where the money actually goes. The bulk of the fund sits in government securities and well-rated corporate bonds. Second, the governance around it. 5 independent parties checking each other, and an annual independent audit. And of course, there is a regulator watching over all of it. And third, diversification. It isn't left to chance of good intention. It is written into the rules themselves. So that's one of the key factors about the collective investment fund, is that it's fairly diversified. Safety here doesn't come from one big promise. It comes from several smaller reinforced safeguards, all of them working together at the same time. I do want to be upfront with you about special funds because they sit a little different from the rest. These funds chase higher returns, often through a specific sector or strategy, sometimes using more sophisticated instruments. That means their value can move up and down more sharply than a balanced or fixed income fund. But even these funds are not a free-for-all. They still have a documented investment strategy disclosed to you upfront, and they still must spread their risk rather than betting everything in one position. And they are still subject to the same licensing, reporting, and audit requirements as any other fund. More risk, yes, but never without rules. Now that we have examined in details a structure in place to build a robust investment portfolio, here is a summary of what we have discussed. We have a system in place that approves funds before they can even solicit from the public, and also ensure that public funds are protected through oversight. There are 5 independent parties that provide checks and balances. And then there is the rules like Regulation 75, which ensures diversity is built in. And finally, there is a basket of funds to cater for every kind of investor, from the conservative to those who are risk takers. Before I present you with my data and examine the details of what I was able to dig out, let's just examine how funds last year were managed under the CIS, the total asset under management. Let's examine how they were allocated. Now, as you can see from the charts, 43% was allocated to government securities. These are short-term securities like treasuries and long-term securities like bonds. Another 28% was in fixed deposits. You know, this fund has a huge chunk of money, and they're able to negotiate good returns from banks for any money held in their deposits. And then like 12% is in cash and deposits. This is for liquidity purposes. In case members need to withdraw money, there's always cash available for that. Another 6% was allocated to offshore listed companies. As we have learned, funds like the special funds have that ability and leeway on where they can invest their money. So part of it was invested in listed stock exchanges like the New York Stock Exchange, the London Stock Exchange, the Hong Kong, the Tokyo, and that constitute around 6%. Another 5% was allocated to offshore unlisted investments. This includes, like private placements in companies, and then at the end of the day, you get a return from your placement. So around 5% was in offshore unlisted entities. Another 3% was in unlisted entities here locally. This again includes private placement of cash into companies that you feel have the potential for growth, and as they grow, you get a return out of it. The other include now the Nairobi Stock Exchange, only 3%. And actually, if you remember from our analysis, it was something like 0.5. You have to remember the Nairobi Stock Exchange did tremendously last year. But what it means is the funds in CIS, very little allocated any funds to the stock. And the reason is simple. The stock is the most risky fund, so it looks like managers were risk averse. They did not want to allocate a lot of their money into stocks. So the growth we experienced in Nairobi Stock Exchange was investors buying directly and not through funds under the CIS scheme. Like I promised, let me now show you the data. As you can see, these are the different categories of funds that I was able to collect data to do my analysis. They range from the most conservative, which is the money market funds, to the one with the highest risk, which is the equities. And as a potential investor, you can pick on any of these and then allocate your funds depending on your level of risk. And that's the real genius of this scheme. It has a basket of funds that suit every different kind of investor, from those who are risk averse to those who are willing to take a risk. And they range from the money markets, the least, to the equities. And in between, you have the fixed income, you have the equity funds, you have the balance funds, and you have the special funds. The money markets and the fixed income invest heavily on government securities, so they are pretty safe. Then you have the balanced and the special funds, which allocate some money to listed companies or into private entities, and so those ones have like a medium. And then on the other extreme end, we have the equities, which have the highest risk. So there's a basket to choose from, and as an investor, depending on your risk appetite and your financial goal, you can allocate proportionally. Usually equities and special funds and probably balanced funds are ideal for growth, if you want to grow your portfolio. Money markets and fixed income, those ones are usually good for capital preservation. As we go through each tab, you can see the funds that I was able to collect data from, their annualized return last year and part of this year, and then you get the average. So that's for the money market fund. This is for the money market funds, those that invest in USD dollars. Again, the return might be low, but it's because it's in US dollars. Then we have the fixed income, and these are the funds. This is their returns. As you can see, it's getting higher and higher. The lower the risk, the lower the return. As the risk increases, the return also goes up. Next, we have the special funds. Oh, just look at that. What made the special funds perform pretty well is because they allocated some of their money in equities and some of them in bonds. And equities did extremely well last year. That's why in their returns, it reflects that. And then you have the special funds. Again, fantastic returns. Same reason. They took a much bigger risk. Equities, unfortunately, there isn't a lot of data out there. But then again, as we also did in our analysis, assets under management under CIS only allocated 0.5%. So the one fund that I was able to get that purely invests in equities, just look at that performance. Incredible. So once I took all this data, I was able to come with a return of around 19.91%. I mean, this is incredible. And that includes me including the USD money market one. If I removed it, it would definitely be 20%. But then you have to remember, in investment, past performances is not an indication of where the fund will perform in future, but at least past performances give you an idea. So realistically, I would say around 10 to 15% is a more realistic return, because it would balance out the years that it does very well and the years that it doesn't do very well. And then again, as an individual, like I said, you can also allocate proportionally. If you want to take more risk, maybe you can put more funds in the balance, in the special funds and the equity funds, and of course you'll have a higher return. But also remember, the higher the return, the higher the risk. So in bad times, you may also see a very significant drop. But if you are more conservative, then maybe you'd allocate more funds to the more conservative funds, like the money markets and the fixed income. I want you to take time, just pause and go through my data, then analyze for yourself. Is this something that would interest you? Is it something that you would consider adding to your portfolio, making the capital markets as part of your investment strategy? Now, I'm not advocating to replace real estate with capital markets. No, that's not the whole idea. The idea is diversification. Capital markets can give you a return which is as competitive, if not even better, than real estate. But as an investor, it's always good to balance. Have capital market, have fixed assets like real estate and many other assets that you may have in mind. But there's one advantage of capital markets. It's much easier and less hassle to set up and to manage than real estate, and it's also easier to liquidate when you need the cash. So those are some of the things to think about and weigh as you build your portfolio. My hope is that the data has provided a detailed explanation of my super duper chama, as I call it, and that it forms a good basis for you to start investigating and considering to adding it to your portfolio. And with that, bye bye, and let's meet again next time.